Well, good evening, everybody. My name is Joshua Swearingen. I'm with TUSK Practice Sales, and I'm thrilled to be with you this evening just to talk through some of the consolidation that's going in the medical aesthetic space and really have an enjoyable conversation about where we are today, where we believe we're going to be going, and what that could look like for you as a private practice owner, be that in the med spa space or other healthcare verticals. For the agenda this evening, we'll go through a quick introduction and we'll talk a little bit about what we at Tusk Practice Sales do. We'll talk a little bit about healthcare consolidation, some of the common themes between the medical aesthetics space and other healthcare verticals that have consolidated before medical aesthetics, and then where we believe this is going in the future. Let's take care of a little bit of housekeeping here first. As an introduction, again, my name is Joshua Swearingen. I've been with TUSK Practice Sales for a couple of years now, but have spent much of the last 20 years of my life in various healthcare verticals, a lot of that within dentistry. Had the opportunity to operate as the CEO for a couple of large group practices in the Central Ohio market, one of which we built up and sold to private equity in 2018. I worked with American Dental Partners, which is a national dental service organization of over 400 locations on their mergers and acquisitions team, and then now with TUSK. And then in my personal time, I'm also the co-owner and founder of Reverse Aesthetics, which is a medical aesthetics practice in Columbus, Ohio. And we do all of your traditional Botox and fillers, and then we also run several different lasers and a lot of different anti-aging and hormone therapy treatments as well. So needless to say, I'm incredibly passionate about this space and excited about where it's heading in the future. So just to introduce you to TUSK Practice Sales, we have 14 fully dedicated team members with well over 120 years of healthcare and 50 years of investment banking experience. We've closed over $1 billion in healthcare deals across multiple healthcare verticals in the last 6 to 7 years, and are regularly referenced in healthcare publications across a broad spectrum of healthcare industries. If you look at our experience and you dial into that, we have a huge section of investment banking experience on our team, working for Fortune 200 companies, Fortune 300 companies, all the way up through small little family offices. And on the healthcare side, we have a lot of experience working with providers and distributors and various manufacturers within multiple healthcare arenas. So healthcare consolidation, and I get this question relatively regularly, which is, we've seen other verticals that have consolidated before medical aesthetics. We hear all of the conversation about private equity groups and all of these large group practices. We receive offers for some of these groups, but we really don't know what to make of it. And we don't really fully grasp what that looks like as the industry matures over the last 10 to 15 years. So that's really what we're going to focus on this evening and dig into, really based upon the precedents that some of these other healthcare spaces have set. I think we transition the conversation to where do we stand in the space as it relates to other healthcare verticals. And obviously the first one that we can look at is medical consolidation. And if we look back over the history of that, which is 25 years, but really even before that, you have two large entities that have come out on top of that space, those being either universities or educational facilities and the hospital systems. And what started a long time ago with private practices kind of being slowly aggregated or acquired by some of these larger entities have now become a complete monopoly of the space. So you'll actually be hard pressed to find a medical office out there that isn't in some way affiliated with either a hospital system or a university healthcare system. And that represents roughly 85 to 90% of healthcare. Those remaining 10 or so percent really are focused on kind of some of your really small specialty practices, even breaking into our space a little bit, the anti-aging facilities and things like that, or what we would consider boutique practices that either have the ability to operate in a fee-for-service environment entirely on their own, or really aren't businesses that most of these healthcare facilities are interested in adding in. And then as we move on and we look at kind of the next vertical we're going to discuss, we look at dental consolidation. And this consolidation has actually looked reasonably different, at least in its infancy, than medical has. We know that we're roughly 30 to 35% consolidated. And when I talk about consolidation, just so we're all on the same page, we're talking about large groups that are private equity backed. We're not talking in general about a 5 or a 6 location group or a 10 or a 15 location group or something like that, of which there are many, many of those. We're really referring specifically to a group that has gone out and received external funding in the form of private equity, venture capital, a family fund, something along those lines, and are now in the business of buying other businesses. So that's representative of roughly 30 to 35% of the dental space. And really over the last couple of years, we've started to see that snowball. So in a lot of these various verticals, it'll start out really, really slow. And then you'll have various benchmarks that you hit. And once you hit that benchmark, that consolidation starts to accelerate faster and faster and faster. And some of that is a result of these owners, being medical practice owners, dental practice owners, med spa owners, whatever business it is, looking around the marketplace, seeing the deals and the valuations that are available, and really suffering from some level of a fear of missing out and not wanting to miss that opportunity that exists in the space, which is one of the reasons why we're talking about this right now. So as we move on and we get into med spa consolidations, the aesthetic space, by all indications, we're really only about 3 to 5% consolidated. It's a very young industry from a private equity perspective. And it's really a funny conversation. TUSK has been in healthcare for 7 years now. We've done a lot of deals. We've done a lot of deals in various verticals. And it's really been over the last year and a half that we've taken note of the med spa space, largely because a lot of the private equity groups that we have partnered with on other healthcare deals, or that we have sold businesses to within other healthcare verticals, are now looking at the med spa space and realizing, hey, there's a tremendous amount of opportunity there, and we're looking for people in the space that can represent these businesses. So it's really an interesting conversation when we sit down with some of these private equity groups that we know very, very well and discuss how much opportunity there is within the med spa space and where it's ultimately going to end up. And you don't really have to search very far to realize why that is the case. If we look at US cosmetic surgery market, the global med spa market, growth numbers across the board, it doesn't take a rocket scientist to figure out why you would have private equity rushing into this space. You're getting roughly 9% annual growth rate year over year anticipated for the next 8 to 10 years within cosmetic surgery. And some would say that that's a very, very light estimate. So there is tremendous growth within a space that is largely unregulated by health insurance. So a lot of profit opportunity. And in many cases, you have business owners who are providers and clinicians and who may not really enjoy certain elements of running that business. And then if we shift over to the medical spa market, everybody knows this space is exploding. All you have to do is look at the number of trade shows that are available out there right now, and you can see a tenfold increase in the number of opportunities that you as a provider have to go learn about many of the same things at all of these different trade shows. We're anticipating growth from roughly 19 billion to almost 50 billion over the next 8 to 10 years. And again, that is a number that many prognosticators believe might be a little bit light. We really haven't tapped into some of the largest segments of the market, and the US population is aging at a rate that is going to introduce a lot of new users into the medical spa space a lot earlier than anticipated. So all of these things together, along with the fact that it's really largely a mom and pop industry. The opening up a business is, in many cases, it's a provider that has either worked in the healthcare system previously and is interested in getting into something that has a little bit more attractive hours or a little bit more attractive business profile, deciding that they want to hang a shingle and open up a shop. And there's not a whole lot of regulatory limitation in doing that. So what private equity does is they will step in and they'll provide the business infrastructure and help to offer that infrastructure to the businesses so that the providers can provide and operate within the business and treat patients and take care of their constituency, and all the business operations are handled by business professionals. So it is very much a symbiotic relationship, and in many cases, not all, but in many cases, it can be a remarkably healthy relationship for a very, very long time. So as we move into consolidation, and this is really kind of what I want to focus on for the next few minutes. Many of you are kind of asking about what's next, and we get questions all the time from clients of ours that we're talking to, or provider owners who may not have contracted with us yet but are interested in contracting with us, that they really don't know when is the right time to sell their business, and they may not truly be educated on the opportunities that exist in the marketplace, the valuations that are there, or really what some of those inherent risks are in selling your business. So I just want to talk through the timeline for a few minutes to give you an idea of what we've experienced in other spaces and how we believe that is going to play out within the aesthetic space. So obviously you have phase one, which is platform development. And when I talk about platform, this is generally kind of an initial private equity funding. So when a private equity group enters the marketplace, they're not really looking to buy a single location here and a single location there and a single location over there and build off of that. When they're looking to enter the market, they're looking for a group that theoretically has some level of infrastructure built within it. And when I say infrastructure, I mean management infrastructure that is housed within that business that the private equity group can lend capital to and build around. So you have a number of these all over the country, which are 6, 7, 10, 12 locations, and a private equity group comes in and buys up those locations, adds a couple of back office people, a business development person, some human resources help, maybe some marketing help, and then the capital to continue expanding. And then they'll go out and start purchasing single locations to add into that platform. Who does that benefit? Well, obviously, since they're not looking at private practices right away, that's going to benefit your larger multi-site groups. And there are quite a few of these around the country. And in general, they're looking for multiple locations, or at the very least in the neighborhood of $2 to $5 million in EBITDA. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's essentially a baseline measurement of cash flow and profitability within the practice. And one of the things that we at TUSK do initially with all of our potential clients, and then ultimately with our clients, is what we call a TUSK val. And it's a basic market valuation of your business to give you an idea of what a clear EBITDA looks like on your business and how we believe the market will receive that and what the valuation for the business is. And just to let you know, we do this service free of charge. We just need a couple of practice management reports and QuickBook reports to accomplish it. Doesn't take very long for us to turn it around, and we can give you a really good idea of where ultimately we feel your value in the market would fall. So back to these large multi-site groups, $2 to $5 million in cash flow or profits or EBITDA. And really they're looking for reasonable synergies between their practices with some level of infrastructure. And when I talk about reasonable synergies, I think there's always there are always entrepreneurs in the space that look at their initial practice and then they just want to open other dots on the map, many of which may not correlate very well. There may not be a strategy behind it. They may not have consistent business operations or business offerings, clinical offerings from business to business. And when you're an investor looking at these businesses and you have three completely different practices that are all underneath this platform, it's really hard to figure out what those synergies are going to look like and how you're going to maximize the platform. So I think that, if you're a group, or if you're looking at building a group that you will ultimately sell off to private equity, you really want to make sure that you have kind of standard operating procedures in place that are consistent across all of your practices. And you have some level of infrastructure that can kind of keep an eye on operations within the business to ensure that they're all operating roughly the same and treating patients the same with the same clinical offerings, things like that. So those are initially the largest benefactors of private equity investment, these larger multi-site platforms. Phase one platform development is usually in that 0 to 10% consolidated. Once you hit 10% consolidation, you've got a pretty solid group of large group practices, or a pretty solid group of management services organizations, or whatever you want to refer to them as. And they will then start moving out and buying up private practices to add to their numbers. So in that 0 to 10% consolidation range, which is where we are now, we still have a lot of private equity coming into the space looking for platforms. So once we get past this kind of phase one platform and we're beyond that 0 to 10% consolidated stage, we really hit phase two, which is your infrastructure and growth. And this is really what we would refer to as kind of the golden age of valuations. This is when generational wealth can be created in the sale of your business, and earning first in equity in some of these platforms, which can be unbelievably valuable, is generally offered for these earlier sales opportunities, or these earlier practice acquisitions. So I think it's important to realize that these are kind of benchmarks, but they're not completely clean. I say 10 to 40% consolidated is a great opportunity for you to see valuations increase and sell your practice and things like that. But even now, within the 0 to 10% consolidated space, which is where we are right now, there are a lot of platforms out there that are already competing for some of the same available practices. So some of this has less to do with where exactly we are in the consolidation phase, and more to do with how many active buyers there are out in the space. And some of that's geographically dependent, some of it's dependent upon the size of your business, and some of it has other variables that are attached to it. And I think that really lends itself to why, as an organization, we go broadly when we represent businesses in the space. We want to make sure that you're not getting one offer from the group that's out there buying everybody. We want to make sure that you're receiving 6 or 7 offers from groups that are purchasing, as well as 3 or 4 offers from groups that you may never have even heard of. Because ultimately, at the end of the day, we want to create a competitive environment, and we want these groups to be falling all over themselves to pay a premium for your business. So I think that there's a lot of gray area within these consolidation numbers, and it behooves yourself to get out there, get a practice valuation, sit down and talk with myself or one of our advisors and discuss your geography, your business, and where we feel your business would be valued at this stage of the game. So anyway, back to the presentation. I digress. Between that 10 and 40% consolidation range, who benefits most? These are healthy private practices. These are your single location, your multi-site, small multi-site groups, $250,000 to $2 million in EBITDA, or net cash flow, profit, however you want to term it, that can be relatively easily folded into larger platforms. Many of them will be single locations, or maybe smaller 2 or 3 location groups, but these are the practices that are going to benefit once we hit that really 8 to 10% tipping point. And then moving forward, once we hit that 40% consolidated range, and this is actually a study that you can reference back to the dental space really, really easily, because this is the space that dentistry is heading into right now. That's management services organizations or your large PE-backed groups, that's their group consolidation. So at some point, these groups get large enough where buying a private practice or a single location or this or the other just doesn't move the needle enough. They have excess capital, they have a well-developed infrastructure, they have access to enough dry powder or money to handle a very, very large transaction. And that's what they begin to look for. So once we hit this stage, and this stage, once you hit it, it happens really, really fast. This is where these mid-tier groups and practices ultimately start acquiring each other. So you'll have a group of 30 locations that's private equity backed and a group of 15 locations that's privately backed. And the 30 location will acquire the 15 location. And now there are 45 location underneath a different private equity umbrella. And that's where a lot of the mergers and acquisitions activity occurs in these latter stages of consolidation. And as a simple word of warning, once you get to that 40% consolidated state, you start to see private practice valuations plummet somewhat considerably, because you've now switched from having a broad field of buyers to a much narrower group of buyers, many of whom may be in the sale process themselves, being acquired by other even larger entities. So as I mentioned, the sweet spot is in that 10 to 40% consolidated, but you really do need to be looking out for hitting that 40% range, which we're really 7, 10, 12 years away from, because that's really the tipping point when you'll start to see valuations for your single location begin to really drop. As we look at expectations moving forward, it's helpful to kind of know where we are today. And if you look at private practices locations, right now, roughly 80% of the market is comprised of single location groups. And we move over a category, and the middle market, which would be your 2 to 25 location groups, these are your ideal platforms, represent about 15% of the market. And then your elite groups, which are 25 locations or more, represent about 5% of the market. We anticipate, just based on current growth trends, that over the next 5 years, private practices will drop by about 20% and will represent about 60% of the market. That middle area will grow to 25% of the market, and then the elite group will grow to 15% of the market. And you can see this slow trend of consolidation that ultimately ends up in the bucket of the elite level groups. So in all reality, we can talk about where we are in the stage of consolidations really, really easily, but there's a lot of fluidity in those numbers, and a few really, really large transactions could tip the bucket rather significantly and start almost a buying frenzy among some of these elite groups, which is, as a private practice owner, exactly what you want to have happen, because that opens up opportunities for you to build a level of wealth within the space that wasn't available 5 or 10 years ago, just simply wasn't there. So that's one of the reasons we get excited about it, and one of the reasons that we're so excited to represent med spas in the space, aesthetic businesses in the space, because the numbers that you will see kind of jump off the paper at you and will really shock you and set you up for many years to come. And I think one of the important things to think about when you're looking through these numbers and you're theoretically planning kind of some of the next stages of your career is to realize that all of this is very, very fluid. And really the only way that you can gauge what your business is truly worth is to have evaluation done and make sure that the broader market is getting a look at your business as a whole to see what that valuation is going to look like. What are some of the key takeaways that we have? Well, I mean, we know for a fact that this space is growing at an incredibly rapid pace, and consolidation within the space will accelerate at an equal rate. So when we talk about, our industry is 3 to 5% consolidated, that could change to 4 to 6 or 5 to 7 in the next 6 months. It really could happen very, very quickly, and it would only take a couple of really large transactions for that to occur. And to be clear, we don't believe that private equity is going to back out of this industry anytime soon. We're not under any significant regulatory risk that could cause significant problems for private equity ownership down the road. If anything, some of the regulatory conversations that are being had around the services that providers are allowed to offer, what type of oversight is required, things like that, actually benefit a lot of these private equity groups and the platforms that they maintain, simply because they have the necessary infrastructure to implement some of these changes across a broad scale. So I think that if anything, as we start to see some crackdown on some of these regulatory items, we're going to see consolidation actually accelerate in response to that. Second, I think we're really entering the golden age of private practice ownership. 3 to 5% is a really nice number. 10% is a great tipping point, but we are seeing valuations hit significant highs right now. Really, really good multiple numbers, and from a planning standpoint, in many cases, if you find some of these private equity backed groups, being first in has huge value. Being one of the first acquisitions after their platform investment, being one of the first people to invest in their platform as an owner operator, can have huge value, just because the stock, growing from 10 locations to 50 locations, and getting a 5x on your money is a lot different than growing from 50 locations to 500 locations or 250 locations to get a 5x. So just a much easier row to hoe. So I think that we'll continue to see generational wealth created in this space. We're going to continue to see valuations really be at all-time highs, which is great. Another thing to remember is, buyers are going to get more and more aggressive in attempting to keep the purchasing environment free of competition. There are absolutely amazing groups that are out there with incredible leadership, and we talk to them on a daily basis. In many cases, we're good friends with them. In many cases, we meet up with them at meetings and the like, and they're just very, very good people, well-run organizations. But the reality is that their business model is to buy a practice, pay as little as they possibly can for that practice, and then bundle that together with other similar practices, sell those all as a group at a premium. And that's how they make money. And the difference between what they pay you for the business and they're able to receive as a part of the whole when they sell, that's called arbitrage. And arbitrage is how private equity groups measure success, how they pay back their investors, and how they ultimately spin out and invest in other businesses. So they are highly incentivized to keep valuations reasonable, if not lower than market, in any situation possible. So from that perspective, we love getting involved in these early on. We love representing med spa owners simply because there is an aggressive market out there that goes well beyond the 1 or 2 unsolicited offers you may have received in the mail or on a postcard or something to that effect. So you owe it to yourself and your business to test the market and see what's available out there. I also think, and this isn't a point that made its way onto my slides, but I think it's really important to realize that private equity is not something to be feared. It will certainly change the way businesses operate in many respects, but there are a lot of really, really incredible private equity groups that are out there. And the thing that we love is that, having done well over $1 billion in healthcare transactions over the last 6, 7, 8 years, we've worked with a lot of private equity groups, many of which are amazing, and a few of which are really not amazing. And having that foresight and understanding of the space allows us to guide our sellers in making a decision that ultimately will impact them for years to come. So I don't think that it's something to shy away from. It's something to understand a little bit better about your business and your market. And there is no reason to be fearful of some of the changes that are coming down the pipeline. So that's it for this evening. I really appreciate you joining me and walking through some of this information. As I mentioned, you can reach out to us at any point in time for a pre-practice valuation. It's easy for us to undertake on your behalf. We can give you an idea of what your baseline EBITDA number looks like, and we can give you an idea of where we believe the market would support a sale of your practice, and discuss some of the different deal structures that many of these groups offer. Feel free to reach out to me at josh@tuskpracticesales.com. I respond to everything within a reasonably quick turnaround, and we'll be happy to take it offline with you at a later date. So thanks for joining us this evening, and have a great day.